The Joe Gelly Show.
Welcome back, mi gente. I'm your host, Ida Jogeli. Understanding finance is imperative if you want to keep most of your hard-earned money. We'll be covering a lot of ground so that you don't have to repeat the mistakes of the past. And even if you grasp this one concept really well, there are a lot of other forces that will affect whether your wealth goes up or down. The most foolish thing you can do is oversimplify concepts into rules that sound intelligent, but if you do a little bit of history research, it actually doesn't make any sense. That is why when it comes to the broad markets, predicting whether an index of 500 companies or 1,000 companies will rise or fall is a lost cause if you're solely looking at the Fed's interest rates for your predictions. The most prudent prediction is no prediction. You could be right, you could be wrong. Only time will tell whether it was due to skill or due to luck. So just be prepared for either scenario to play out, up or down. With that said, here's how I use interest rates to gauge the economy and brainstorm the possibilities of where the markets might be headed. But first, a little background on inflation and the Fed. Inflation is everywhere. Throughout history, wherever there has been money, inflation has come with it. Which countries have undergone severe inflation? Babylon, ancient China, England, France, Germany, Argentina, Venezuela, and the United States, and pretty much the entire world has experienced inflation. History has shown that the increase in the money supply and the rising prices is the norm, and by no means a special case scenario. And interestingly, the larger the economic system and the more intertwined with daily living, the more insane inflation becomes. How insane can inflation get? When I say insane, I'm referring to the kind of inflation that seizes wealth and sparks revolutions. No one is exempt from it. Every person is touched by inflation. It's the melody that dictates our net worth, our spendings, our savings. To this day, governments communicate things like, "This time it's different," as they recklessly issue new currency into circulation. But the truth is, the basic mechanics of inflation hasn't changed, and neither has their effects. Society has become completely dependent on using money to exchange for the necessities of everyday life. We don't walk around with 1,000 bikes to trade for a house. We use cash for that. The Federal Reserve Bank. Who issues money in the US? For the last 100 years, it's been the Federal Reserve Bank. That's right, they are the guardians of the money supply. They were put in place in 1914 with the idea that it would be an economic stabilizer, ridding the country of inflation and economic crises. Of course, history shows many crises and inflationary periods since then, including the Wall Street crash of 1929, the recession of 1973, where high unemployment and high inflation coexisted, the bursting of the dot-com bubble in 2000, and the global financial crisis of 2008. The Federal Reserve Bank is not federal. It's not an agency of the United States government. Nope. It's a private corporation. You heard it, a private corporation with the power to control the money supply. And with great power came great responsibility. Or irresponsibility? And with this power, they can financially engineer booms and busts when desired. Interest rate control. How does the Fed increase the money supply? The first monetary policy the Fed reaches for is interest rate control. Just recently, the Fed decreased interest rates from 1.58% in February of 2020 down to 0.08% today in September 2021. So if you're wondering what is the Federal Reserve interest rate today, you're in luck, because all the raw data is publicly available from the Board of Governors of the Federal Reserve System. If you're more of a visual person like me, the St. Louis Fed website is the place to go to view really nice graphs with data. Yes, I love data, and I love graphs. The effective federal funds rate chart. So this is the effective federal funds rate chart. The federal funds rate is the interest rate at which banks lend their excess cash to other banks overnight. It is influenced by the Federal Reserve Bank, who meets 8 times a year to determine the federal funds target rate. Here, the x-axis is the year from 1955 to today, and the y-axis is the percentage interest rate. Here are a few very interesting things to note. Okay, first, we are in an extremely low interest rate environment. Even back in July 1954, the interest rate was at 0.80%. That's 10 times higher than today. Second, these gray shaded areas, those represent periods of recessions. What is a recession? Recessions are periods where economic activity is contracted. Basically, costs are cut, companies lay off workers, and trade and industrial activity is reduced. Those periods of recessions were triggered in part by the rising interest rates, which made it much more difficult to borrow money. Okay, just look at this. In October 1957, the interest rates reached a peak, and the economy entered a recession. Go figure. Then the Fed dropped interest rates and began to increase it, only to trigger another recession in April 1960. Then, the US had one of the longest bull markets in history, from 1962 to 1969, lasting roughly 7 years, and having an increase of 70%, only for the economy to have gotten too hot, crashing the Dow by 35% in 1 year. What did the Fed do in the crash of 1969? When the markets crashed, the Fed tried to come to the rescue by doing, well, what they usually do: decrease interest rates, which once again jump-started another bull market. Go figure. But inflation was once again running too hot. So the Fed had to increase interest rates, which once again crashed the Dow Jones Index by 44% in 1974. The Fed pulled down the emergency brakes on the interest rates, but then had to rapidly increase it to stop the United States from spiraling into hyperinflation. You're probably wondering, how high did interest rates get in the 1970s? Interest rates hit the highest in history, 19.04% in July 1981. Keep in mind that the federal funds rates spills into other forms of credit, affecting the entire economy. For instance, if you want to take out, say, a business loan or an auto loan or a house loan, everyone, and I mean everyone, is affected by the Fed's policies. Just imagine going out to buy a house on credit in the year 1980 and being offered an 18% yearly interest rate on the loan. Isn't that just insane? That is just unbearable. How has interest rates behaved since the 1980s? Ever since 1981, the effective federal funds rate has been declining steadily. Anytime the Fed tries to increase rates, it triggers a recession. But hey, the Fed knows well how to shorten recessions. Just pull the interest rates down, like here in 1989, in the year 2000, and in the year 2007. The Fed has been trying to raise interest rates to stop inflation from getting too hot. Because if inflation gets out of control, it would mean the collapse of the dollar as we know it. People would lose trust in it and start wanting to just get rid of it fast. So they trade cash for any asset they can find. Take my money, take my money, take my money. And that would make inflation worse and worse. If you are still a sleepy camaron, you'll wake up to find out that you've been priced out. Your money is worthless. It's not enough to buy anything anymore. That house you wanted to buy? Nope. Surprise, surprise. Can't do it. It's double the price. Instead of prices increasing 2% a year, it's now 2% a month. And the more people rush to get rid of cash, the faster inflation takes over. Perhaps increases in prices of 2% a day or 2% an hour. Those are completely possible scenarios. You can't say it can't happen to you. Look here at the graph from 2006 to 2021. Interest rates were darn low since the collapse of the housing market in 2007 to 2008. After a long recession, interest rates had been steadily climbing from 0.12% in November 2015 to 0.40% in July 2019, only to be pulled down to 1.55% in November 2019. This was due to a sudden spike in the repo markets, Wish we can talk more about another time if you like. Just let me know in the comments below. I'm listening. But back to the graph. From November 2019, the federal funds rate was pretty steady until February 2020. Yep, you all remember that month when the Fed dropped the federal funds rate down to 0.05% over the next 3 months until April 2020. It has been hovering low ever since then. So, what consequences has low interest rates brought us today? Well, it's pretty bad. It's pretty bad indeed. We got an everything bubble. Tech, houses, crypto, commodities, you name it. Hold on. What are commodities? Most commodities are basic raw materials that are used to make other goods. When money is first injected into the economy, it creates high demand for stuff, since it takes a while for prices to adjust to the new money. Goods get bought out fast, creating shortages. Shortages means that the price is not high enough. So for supply to meet demand, the prices of most things has been steadily increasing over time. How can you tell if commodities have been going up? Take a look at the Bloomberg's Commodity Spot Index. This index tracks 23 energy, metals, and crop futures contracts. You must be wondering, how are the low interest rates affecting commodities? The Commodity Spot Index is increasing at a record pace. In fact, it is up 62% year over year, the fastest since January 1980. This is why things have been out of stock. Bidding wars on homes are a thing now, and hard-to-get video cards are being resold at higher prices only. Energy is one of the most important commodities in the world, and it is the top among the winners in inflation year over year. Natural gas has gone up 129% and gasoline 64% up. This relationship between commodities, energy, and money supply is nothing new. And we can definitely learn from history to take some self-defense measures to preserve our wealth. Jogeli, I get it. Interest rates are insanely low. But how will interest rates change in the future? I fear that we are gonna have one of the biggest interest rate squeezes yet, something like to the height of the 1980s. Just look, the interest rate has nowhere to go but up. The Fed has spoken that they plan to increase it soon. How soon will the Fed hike rates? Maybe this year, maybe next year. It's subject to change. But when it does hike, it's gonna make borrowing money insanely expensive. People will have to be way more frugal about whether they use leverage, debt in their investments and speculations. Heck, people are so confident that the markets only go up that some are buying the index on leverage, on borrowed money, making the index even more overvalued. If for some reason all these people get squeezed and have to sell, it's gonna be a severe decline. And declines can last a long time. You wouldn't want to be waiting 10 years to get your money back without a loss, but also without having made any gains. How do rising interest rates affect growth companies? Growth companies tend to be highly leveraged companies that depend on access to easy credit to attain fast growth. Those growth companies, like technology companies, have historically shown how vulnerable they are to interest rate increases. Take a peek at the NASDAQ 100 index, the stock market index that is heavily weighted towards information technology companies. The NASDAQ 100 has been going up full force since the Fed's March 2020 monetary injection. And now, with the Fed talking about toning down the money printing, the NASDAQ 100 has been having a rocky decline downwards. If the Fed keeps rates low for too long, inflation will debase the dollar. And if the Fed increases rates, the stock of overvalued companies will be crushed, affecting people's savings and retirement plans. What we can do now is protect ourselves against either possibilities. I'm Aida Jogeli. Thanks for learning with me today, and I'll see you in the next one. That's all, folks. Catch new episodes of The Joe Gelly Show. Plus, get exclusive content for free only on joegelly.com. Go to joegelly.com and sign up now.